So in the last session, what we did was we had revised up very basics of Basel, which we had discussed previously, right? So we had talked about the concepts of default. We had talked about the concept of expected loss. So we had talked about the concept of risk management, business strategies, origination scorecards. We talked about behavior strategies, capital management, etc. So in Crux, the last session's discussion states that Basel as an accord, right, or is a set of guidelines, right, based on which the bank can plan its capital management strategies, where it can set aside sufficient amount of capital to overcome its expected losses, unexpected losses, and potential losses. However, when the bank is developing these, whenever the bank is trying to be compliant to the Basel Accords, it has this capital reservation method or this method comes across at different levels. So first, the models are developed at an account level portfolio or for each portfolio, like for personal loans, credit cards, overdraft, mortgages, and then they're added together to see the picture at a retail level. Then the models are developed at a commercial level. The commercial models are separately developed. Then they are brought together to see it to get the big picture at a bank level, right? So then at a bank level, the three set of risks: market risk, operational risk, and credit risk. The three come together, and finally, what we get is the capital at the bank level. So this is the so these are the levels at which the models are developed, or this is the these are the levels in which the capital measurement is done, and finally it boils up at the bank level. Now, for making these capital or keeping aside these capital to overcome my unexpected potential losses, we saw that the most basic part to start off with is by estimating the expected losses. So once you get an idea of the expected losses, then you can frame an idea about the unexpected losses that are there, the unexpected losses that can occur. And once you have an idea of the unexpected losses, the next thing that you can frame an idea about is that what exactly are your or what exactly could be the potential losses, right? So that is the framework in which we generally get to see the things. So in yesterday's discussion, we started off talking about we said that while we talk about developing PD models, LGD models, EAD models, and all these models, so these three models enter into explaining the expected loss for a bank, right? On the other hand, if I am developing these expected loss models and also I need to understand the different products and the different sources of riskiness for each of the products, the different risk sources or different sources from which risk may arise for a given product, right? So in the last class, so we started talking about personal loans as a credit product, right? So basically what we saw over there was the following. So let me just remove this and we'll start this page afresh. So we saw that in the discussion from the discussions in the last class that Basel as a capital accord, right, divides the portfolio into two parts. Or divides the banking books or the credit lending books into two parts. One is the retail portfolio and the other is the commercial portfolio. The other that we have over here is the commercial portfolio. Now, the retail portfolio in Basel is defined as a portfolio which has very large number of accounts, and the average exposure of each of the accounts is very small. And how do they define very small? They define very small as a value which is less than say 1 million euro, right? So exposures which are less than 1 million euro are clubbed as retail loans. And one important characteristic of retail loans is that retail loans are estimated, or they are calculated, or they are managed in a collective manner. So you manage them as pools of loans. You do not manage loans very individually because of the fact that the overall exposure of these loans is very less, right? So that is why that is what the retail portfolio for Basel is, and the objective of Basel is to look into each of the products or each of the portfolios, and at each portfolio level to construct the the idea is to construct the what should I say? The idea is to construct the RWAs for each of the products and then pull them up together first at a portfolio level, then at a bank level, and so on, right? So basically, say suppose, so therefore, we need to understand the different sub portfolios in which Basel also splits the entire banking portfolio. So going further, Basel divides the retail portfolio into three parts. One is the QRRE, which talks about the qualifying revolving retail exposures. So within the qualifying revolving retail exposures of QRRE, what we have is we have products like credit cards, overdrafts, and other revolving products, if any, right? Then what we have is the mortgage. So mortgage is the housing loans or the home loans which are collateralized loans, right? Or are secured loans, right? So over here, so mortgage is the second sub portfolio, and the third portfolio that we have is the other retail portfolio. Now, other retail portfolio comprises of other retail loans which can be secured and unsecured, but mostly the other retail sub-segment contains term loans. It contains loans or term products which are which are lent out for a very fixed period of time. So this part contains loans like personal loans, automobile loans, education loans, and so on. So basically, be it secured or unsecured, these loans are term loans, right? So the mortgage is a term loan with a collateral and qualifying revolving retail exposure, revolving exposures, and there is no question of a term loan arising over here. So this is precisely what the behavior is, or this is what is precisely what the overall idea is, right? So this is QRRE, the mortgage, and the other retail. The commercial portfolio is divided based on the size of the clients into two parts. One is the SME or the small and the medium scale enterprises. And the third that and the next that we have over here is the corporates. Have is the corporates, right? So these are the two broad classification that the commercial portfolio has, right? However, there are sub portfolio classifications based on the following. First is it talks about object finance. Object finance, vehicle finance, And the third that we have over here is high volatility high volatility mortgage portfolio. High volatility residential mortgages or something like this. So it's the business mortgages. So there are these different sub portfolios as well. Now the type of borrowers within commercial portfolios are of two types. One is the SMEs whose turnover or whose sales proceeds are less than equal to 50 million euro. For corporates are those whose is greater than 50 million. Right. So these are the two types of broad obligors which are there on the commercial portfolios, and based on the product we have the portfolio sub classifications, right? Now, so basically, you can understand one thing that when we are developing, when we are trying to, so our focus in this module over here mostly would be towards predicting the expected losses, right? And in order to do that, we need to have a very clear understanding of how to develop PD model, LGD model, EAD model, and so on. So over here, our one very core focus, or one very key focus over here that we would have is the so one very core focus over here would be to understand the different products and the sources of riskiness of from each product, right? So basically, if I do not know what are the characteristics of qualifying revolving retail exposure, I would not be able to develop a PD or an LGD or an EAD model. If I do not know what are the characteristics of the other retail products, like what is the characteristic of a personal loan or for a mortgage, I would not be able to do that, right? So I'll not be able to develop the PD model corresponding to that or an LGD model corresponding to that. So basically, so over here, our objective would be to understand the kind of risk or the kind of sources from where the risk for a given product arises, right? And that is the reason why we have been exploring each of these products. And in yesterday's discussion we started talking about the you know we started talking about the personal loans, right? So what exactly is the characteristic of that product? What are the different sources from where riskiness might arise? What are the methods I can use to capture that riskiness? What are the ways of defining probability of default for that model? Right. So how can I make a personal loans data Basel compliant? So how does it go about? What exactly is this product and so on? Right. So similarly, within this other retail product, there would also be a loan like automobile loan, or there would also be a loan like mortgage, right? So I mean, mortgage is a separate portfolio. In the retail portfolio, there would be a loan like mortgage. So the sources from which risks for an auto loan arises and the sources of risk from which for which mortgage risk arises is very different from each other. So what we need to understand is that okay, this is how the entire thing should proceed, right? So we need to understand the QRRE, the mortgage, other retail, and the products within other retail very separately. So each loan has its own characteristics, which is not generally seen in other categories. And mostly the riskiness for a given product arises from the most exclusive factor that a credit product has, right? So we'll start talking. So we'll continue our discussion on the other retail, right? So yesterday we were talking about personal loans as a product. Personal loans, or as we call it, PL. Now over here, we'll try to explore the conditions or the characteristic that Basel has, and we explore the risk properties of personal loans, and from there we'll also look into try to understand how is it that a Basel compliant PD or an LGD or an EAD model can be developed, and what would be the respective business problems of uh, these different models. So PD will have a separate business problem, LGD will have a separate business problem, exposure at default will have a separate business problem, and so on. So, how would this go about? That is what we need to understand, right? So, talking about personal loans. So, first and the most important characteristic of a personal loan is that a personal loan is an unsecured loan. Okay, so before I move on, I'd just like to ask you one thing that so is the perspective of our discussion clear to you? So are we clear as to why we are discussing this and what has been the background under which we are discussing this? Especially Karan, Vishal, and and Akash. The three of you. So the three of you are clear under the background against which I'm bringing in this discussion of personal loan, right? So the flow of the discussion is very important, right? Because when you get to hear that, when you follow it in a flow, that entire picture runs through your mind, and having this entire picture running through the mind is very important when you are appearing for your interviews, right? Great. So the first part that we have is the unsecured loan. So the first characteristic of this product is that it's an unsecured product. So it means I do not have any collateral associated with this loan. So if someone is taking a personal loan, I do not need to keep aside any securities associated with it. So there is no collaterals. No collaterals. The second characteristic is that it's a closed-ended business product. It's a closed-end product, right? So that means it has a fixed term of maturity, right? So what we have over here is so there would be a fixed maturity. Therefore, this is essentially a term loan that we have over here. A term loan. So one case was that we have over here is so the first characteristic is that it is unsecured. The second is it's a closed-end product, and the third that we have the third characteristic over here is that there is a fixed EMI that needs to be paid. So fixed EMI, fixed EMI that is it is an amortized asset. So it's an asset which is amortized at fair value. So it's an amortized asset. So the question that comes out over here is what exactly is an amortized asset? So what do I mean by amortization? So amortization is the term, or it's a counterpart of the depreciation term of for physical assets. So for physical assets, we generally use the term depreciation, right? So what do I mean by depreciation? By depreciation, what I mean is the following: that uh, that you have an asset and the asset value depreciating, and you're writing off the value at a constant rate. Say I am depreciating the asset. I know that the asset more or less depreciates 10% every year. So I'm writing it off at 10%, right? So that is what is so that is what depreciation is. Now with depreciation, I'm writing it off at a constant rate at every month, every year like this. So loans or the loan EMIs or such contractual assets, right, which has a fixed contractual cash flow. For such assets, there the term amortization applies because loan is something, it's an intangible asset, right? So you cannot feel a loan, right? You have given a money to someone, someone is paying back the money. So that is what is the that is what is EMI. So that is what is a loan asset, right? And you are writing off that asset in the books of the bank at a certain rate at every month. So at every year, the guy is paying back the funds, right? So the guy is paying back the money, and as the money gets paid, what happens is the entire thing, So as the money gets paid, uh, the bank starts writing off the asset from its books at a constant rate, and that is what it is. That is why it's called amortize, and that writing of the thing at at a constant rate, that is known as amortization, right? That's called a loan amortization. Uh, so basically, another important thing is since it's a fixed EMI that the person is paying, so there is a fixed contractual cash flow for this asset. Fixed contractual cash flows. Now, this kind of a product, right, under the IFRS 9 regulation, so what we club as other retail over here, right? So we are clubbing it in terms of its product characteristics, right? That what we have is a this is it's a retail product as per the definition of Basel. It's a fixed end product and so on. So what we are trying to do is we are trying to so we try to define the product in terms of these certain characteristics, right? Now, the next thing, if you think about it from an IFRS 9 perspective, right? So how is IFRS 9 defined? They're different from Basel. Now, if you look into it, Basel is trying to club the asset personal loan in terms of its behavioral characteristics. So it's an unsecured loan, it's a term loan, it's a loan, it's a retail loan based on its exposure and based on the number of obligors subscribing to it, and based on the purpose for which this loan is being taken, right? Based on the exposure that it has. So based on the exposure, Basel classifies it as an other retail product. Now, what IFRS 9 does is IFRS 9 classifies this from its cash flow behavior, from its accounting or from its valuation perspective, right? So IFRS 9 is an accounting standard, right? So it looks into the asset from the nature of the cash flow that it generates. And it is seen that this asset is something which IFRS 9 calls SPPI, solely principal and payments of interest. So what the only payments that come in payments of principal and interest, right? Solely payments of principal and interest. So the whatever cash flow comes in from a personal loan into the books of the bank as an asset, right? It's a contractual cash flow. It's a fixed contractual cash flow in the form of an EMI, which is comprised of principal and interest payments. Therefore, this product is classified under IFRS 9 as an SPPI, or it passes the SPPI test. So, what is an SPPI test? So, it is an asset or you can say that it's an SPPI asset. So it is an asset which passes the solely payment of principal and interest risks. Payment of principal and interest, right? Or we call it the SPPI. And we call it SPPI because it has a very definite contractual cash flow. So, one very important thing is to understand is when we talk about these two regulations, right? Basel regulation and Basel regulation and this regulation, IFRS 9. Now, these two are something which is these two are something which is kind of very hot shot in the market these days, right? So basically, what you classify as other retail in Basel is something which is being classified is passing the SPPI test in IFRS 9. So you see that both these two regulations they are classifying the same asset under two different ways. While Basel classifies it on the basis of the exposure, IFRS 9 classifies it basis the nature of the cash flow, right? And why is it doing into the terms of the cash flow? Now, for Basel, the objective of Basel is to keep aside capital and capital reserves, right? So that is why it's more interested with the exposure and the riskiness of the exposure. Whereas uh, IFRS 9 is more concerned with the doubtful debts of a personal loan going doubtful or not. So therefore, it looks into the cash flow and impairment in the cash flows because it is more interested in the provisions. So therefore, you can see that the way the classifications a product is classified in two different regulations differ according to the two objectives, according to the objectives of the two regulations. Right? Great. So now over here we will initially focus on the Basel stuffs, right? We'll try to understand how it is dealt with under Basel. Also, then as we go on, also we look into the IFRS 9 counterpart treatment, that how does delinquency get treated in Basel, or how does credit deterioration get treated in Basel, how it gets treated in IFRS 9, and why is it that the difference between the two is there, right? So over here, so let's think about personal loans, right? From the Basel perspective. Now, Basel wants to ultimate objective of Basel is to set aside capital reservation, right? So it wants to keep aside capital reserves. So therefore, all it is interested to know is in the next 12 months, what is the expected loss from this product, right? What is the expected loss from this product in the next 12 months? What is the unexpected loss? And in the next 12 months, what possibly could be the potential losses? So Basel is always focused on estimating the chances of the borrower to default in the next 12 months, right? So Basel is involved in a forward looking estimation of the default probabilities. And what Basel predicts is, or the objective of the Basel is to predict the chances of default in the next 12 months. Chances of default. Chances of default in the next 12 months. Chances of defaults in the next 12 months. Because the objective of Basel is to keep aside capital reserves or to check for the additional capital reserve that needs to be kept aside due to changes or deterioration in portfolio in the next 12 months. So it is not concerned with a lifetime probability kind of a thing. Now consider the objective of IFRS 9. So what IFRS 9 does is IFRS 9 is interested in keeping aside provisions, right? So therefore, IFRS 9 is more interested to identify the credit deteriorations, right? And hence, IFRS 9 proposes a staging analysis for products like personal loans, right? So before I go into that IFRS 9 comparison, I think I have a question from Karan which I'll take up. Okay, so Karan is asking, what does Basel say about expected losses? Again, making provisions like IFRS. Okay, so Karan, your question is not very clear to me, but I'm just stating my understanding. Do correct me if I am wrong. That you want to know that if we have an expected loss through Basel, why is it again we require IFRS 9 to make provisions, right? Karan, is that right? Okay, okay. Oh, okay, I got your question. So basically, what we do is we basically the when we used to, if you look at the history of provisioning models or the way the provisioning regulations have evolved. So previously, we used to have a very incurred loss framework, right? So basically, once a credit deterioration happens, from that time till that account goes into default, we used to estimate that okay, what is the account, what are the chances of the default, like there's a credit deterioration that has happened. Now, what are the chances that the account will default? How much can we recover, and so on. So that was the incurred loss approach. So once your loss had actually happened, from there you are trying to fix it up somehow. But after that, with the financial accounting standards, they started talking about the next 12 months loss. Now, when they started talking about the next 12 months loss, what happened was the next 12 months loss was based on the Basel expected loss estimates, right? So we estimate the EL or the expected loss. Uh, we measure the expected losses, right? So based on that, we used to compute the next 12 months loss. And we used to put a provision, we put a buffer on that and we would arrive at the provisioning figures. But it would only be for the next 12 months. However, what happened was that expected loss measures or the Basel measures are Basel measure is a through the cycle kind of a PD estimate, right? So it takes into account a large volume of data and over a business cycle it predicts the probability of default. So this so for a given set of macroeconomic situation, the PD is not very sensitive to macroeconomic movements. However, looking into the way the economy is evolving, the economies of the global economy is evolving today, right? So there are a lot of chances, there are a lot of ways where there can be certain macroeconomic abrupt macroeconomic movements, right? And hence it is seen that the expected loss models tend to fail to capture these nuances, right? Sudden changes in macroeconomic scenarios. So there was so in the year 2008 when the financial crisis broke out, many of these expected loss models had failed because they were based on the through the cycle PD and EAD estimates, and hence those models had failed. So it was proposed that models so provisioning models must be sensitive to macroeconomic situations, right? And that is where the role of point-in-time PDs and the IFRS 9 proposal comes in. So the International Financial Reporting Standards, which has been formulated by the International Accounting Standard Boards, they suggested that, or they formulated this rule that, or the guidance that an organization, right, who is creating provisions need not only look into the portfolio factors, but they also need to consider the changing macroeconomic situations in assessing the probability of default of its obligors. Because, say, historically, given a macroeconomic situation, my portfolio has been a very good portfolio and I have secured it such that the loss rates are approximately close to zero. But one fine morning, due to some macroeconomic crashes or due to some changes, suddenly, right, what happens is that the macroeconomic situation just deteriorates, or some crash or something happens, and suddenly the riskiness of the portfolio increases in a discrete manner. Then the probability of default, which is estimated by the model, the probability of default, which is estimated by the through the cycle measures, may fail to predict the sharp increase in the point in time defaults, right? Therefore, it was suggested that provisions, when you are talking about maintaining provisions, it's better you compute the expected credit losses based on a point in time PD, like a PD measure which is sensitive to macroeconomic movements. And with the capital reservation method, or the capital reservation that you are making, you do it based on a through the cycle PD. And that is where these two concepts bifurcated, right? And that is where IFRS 9, that is where provisioning measures, right, impairment, whenever there are loan impairment, doubtful debts, etc., whenever the provisioning for them is done, they are done in compliance to IFRS 9 rate standards. And when you are setting at capital standards or your capital reserves, the expected loss you're computing is for the next 12 months and all, and that is done as per the Basel standards, right? So these two measures, they have now bifurcated, right? So the Basel expected loss that we use is done using a through the cycle PD, and the IFRS 9 expected credit loss that we use is done using a point in time PD. So that is where these two have bifurcated. And also, IFRS 9 as a reporting standard has made substantial enhancements around the concept of the probability of default, right? So that is where we would be coming to in the next stage of, so in the next part of our discussion. So does that answer your question, Karan? Great. Okay. So as we were talking about in the future, so as we are talking about IFRS 9. Okay. Great. Okay. Okay, so I have two questions over here, one from Anirudh and one from Karan. So Anirudh, can you give us some idea between TDC and point in time PD? Yes, Anirudh, when I come to the concept of, when I come to the PD model estimates under IFRS 9 and Basel, we'll come to that. And Karan, to your question that if we can have a clear comparison of Basel and IFRS 9, it will be very clear. Yes, that forms a part of our later stage of our discussion when we talk about provisioning models, right? So initially we'll be focusing on developing PD, LGD and EAD models for the Basel PD, LGD, EAD models. And then when we move into the provisioning models, we'll be taking that part up, right? So initially I'm just bringing in the difference in the way in which a typical asset is tested, or a typical asset is uh, treated in these two different regulations. So that is what I am bringing in over here. Okay. Okay. So yes, so as I was saying that in Basel, so what Basel tries to do is Basel tries to uh, identify the probability of default in the next 12 months, right? And the PD estimate that we get is a through the cycle PD estimate. So we'll come to that. So over here, the dependent variable for the Basel model. So if I develop a Basel PD model, it is y equals to 1 if the borrower defaults in the next 12 months. Next 12 months. So this is always the business problem for a Basel model. So, and in Basel model, this period is fixed, right? So it says that for a retail loan, you have to look into the PD for the next forward-looking PD for the next 12 months. Zero otherwise, right? And hence, from here, what you get is the probability of y equals to 1. And this probability y equal to 1 that you estimate is your Basel PD model for personal loans, right? Now, the same concept of the probability of default, right, in IFRS 9 gets divided into two parts, right? So they have, so there are two concepts which come in is number one is the next 12 months expected loss, obviously, and the second is the lifetime expected credit losses. Now, if we see that the credit has undergone a deterioration, so if the accounts move from stage 1 to stage 2 or stage 3, then we say that okay, this account for this account you have to compute the next the lifetime expected credit losses, right? So what we'll do over here is we'll will not be going into that details of discussion. So when we talk about the provisioning models, we'll be coming back to that. So over here, our focus mostly would be on developing these Basel set of models, right? So when I talk about the Basel model or the Basel PD model, what I'm trying to do is I'm trying to estimate the chances that a borrower would default in the next 12 months. So standing today, as on the 27th of May 2016, or standing on 31st of May 2018, I want to know that what are the chances of my borrowers to go into default in the next 12 months, and based on that, what would be the overall riskiness, and I would be keeping aside my RWA within that. So this is the first. So to assess the riskiness, this is the first part of the model, right? Now, coming to the next part. So Vishal has a question over here. That expect so he's asking that expected losses can be calculated for 12 months and lifetime. Yes. So lifetime expected losses or the distinction between next 12 months and lifetime expected losses are made is made under IFRS 9, but it is not made under the Basel requirement. For Basel, you are always estimating the next 12 months losses. I mean, the next 12 months probability to default, right? So y equals to 1 if the borrower defaults in the next 12 months, right? Now, so over here, one thing is very sure, one thing that we can clearly see over here is that this Basel PD that we are talking, or a PD model that we are talking about, is a behavioral model, because this model assesses the behavior of the borrower and based on and tries to frame an idea about his willingness to pay back the dues that he had taken. So once we have identified that, we know that okay, there is this chance, or once we have identified the behavior of the borrower, we can say that okay, this is what his PD and this is what his LGD is. So the behavioral, so the PD model that we have over here is essentially a behavioral model. In fact, the entire AIRB suite of model is uh, it's a set of behavioral model, right? So after PD, the next question that comes up to us is the question of exposure at default. Right? So what would be the exposure if a borrower defaults in the next 12 months? So in the next 12 months, if a guy defaults, what would be the exposure at default? So the idea over here is to estimate, so standing today, within the next 12 months, if there is any instance of default, what will be the exposure at default? And we take the most conservative measure of the exposure at default. Now, the next and the most important model, so after PD, the next set of most important model that we generally come across in developing AI in the AIRB suite of model is the LGD model, or the loss given default model. So we'll first of all talk about these two structures, right? We'll talk about the PD and the LGD model, the basic concept of PD and LGD model, and then we will relate the PD LGD model back to the sources from personal loan, right? So how would we assess the riskiness of the borrower? So what type of observations should go into the PD model? What type of observations should go into the LGD model? What type of variables for a personal loan should go in developing a PD model for a personal loan? What type of model variable should go into developing a LGD for a personal loan? So I'll just take this question from Karan and I'll move ahead. So most conservative means the most conservative estimate of EAD means the highest estimate of EAD that we can get. So basically we compare the EAD and a downturn EAD, and out of this whichever is maximum we'll consider that, right? So however, EAD model is a kind of offshoot model from these PD and LGD, right? So the two core models that we develop is the PD and LGD model. The EAD model is kind of an offshoot, or a sidekick of the PD model. The reason is, so there is a very specific reason as to why it is so. I will come to that. So, having discussed this idea of PD model, so through the PD model, we are trying to estimate the chances of the borrower to default. Right. Now, the objective of the LGD model is to understand that what would be the loss that we would earn, what would be the loss that would be earned if our model was, so if there was a default, given that an account defaults in the next 12 months, what is the loss that can be incurred on this account? So I need to keep aside capital for this. Now when I'm trying to plan this, right, so there are a lot of different challenges, different lot of concepts which come in together to help us get an idea of this. So the first thing that comes out is, now if you think about the concept of LGD, right? LGD is a very simple concept which talks about, which is defined as, so the loss given default is a very simple, has a very simple, you know, formula. So that is 1 minus the recovery rate. 1 minus the recovery rates. One minus the recovery rate is your LGD, right? So once you know that your LGD is always a fraction, right? And this fraction can also be looked upon as a fraction of the exposure at default, right? So if I think about this second part, the LGD model, right? So LGD is 1 minus the recovery rate. So now you have taken a personal loan, you have been paying the personal loan EMIs, you suddenly lost your job, right? And you became a bad borrower, you defaulted and you could not pay back the remaining of the EMIs. So the moment you lost your job and you missed out on a couple of EMIs, the person understood, the bank identifies that okay, this man is this man has lost his job and it is not possible for him, or he has become irregular in paying back his has become very irregular in paying back his credit. Now, given that he has become he has become this much in paying back his credit, or there's a high chance of default. So his willingness or his capability to pay back the loan has deteriorated, and hence his chances to default in the next 12 months is very high. And given that the next 12 months the borrower defaults, the bank needs to compute the LGD. So what the bank needs to compute is, so standing today, right? Standing today, I need to compute the LGD. So I know that there is an account which has already defaulted as on 31st May. For so from 1st June 2018 to 31st May 2019, I need to frame an estimate of the figure, right? So I need to frame an estimate. Now, when I try to frame that estimate, what do I do? When I try to frame that estimate, one very important factor that I need to understand is the recovery, because if the guy defaults, now obviously it's not that I'll recover the entire money from him tomorrow or day after tomorrow. So there is a huge time gap between the account. As first the account would be written off from the books, it would go to the collections would start up their collection process, and that account would persist for us that process would persist for a substantial period of time, say 24 months, 36 months, whatever it is, right? And from there certain amount would be recovered, and then some part, then it would be written off from the books of the bank, it would be given to some third party for collections. The third party will try collecting some amount of it, and when they are unable to collect anything out of it, whatever is done, and they give back, and then the rest is written off, right? So there is a huge process. So the time when the default occurs, right, and and the time when you actually understand the loss, when the time has occurred, there is a huge time gap in between, right? So so if you are trying to kind of frame the idea for the LGD, you need to frame an idea about the recovery rate. So when you are determining the loss given default model, right, you are not only looking into the behavioral aspect of the model, but also you are looking into the recovery figures. So what you need to ideally predict over here is the recovery factors. So the recovery information is very important, and you are trying to predict this recovery rate. The recovery rates. Right? So over here, the basic problem of an LGD model is to predict recovery rates. And when you are predicting recovery, you need to realize that you are predicting this today, but you will realize that recovery some years down the line. So, say suppose you say that that you are recovering, say basically the personal loan was worth 1 lakh, the guy had paid 35,000 and then he defaulted. Now out of that you say that you predict that you have covered, you would be covering 65,000 in a span of 3 years time. Now 65,000 3 years down the line is not the same as 65,000 today. So that estimated recovery needs to be, or that recovery needs to be discounted to today's value. So basically I am predicting it today, right? So what I want to know is, okay, after the period of 3 years, the expected recovery is 65 out of 65,000. The recovery is 40,000, right? So I'm able to recover 40,000 out of the 65,000. But the question that comes out over here is that 40,000 that I recover 3 years down the line is not the same as the 40,000 that I would have if I got it today. So what happens over here? So there is a time inconsistency in between, right? So given that there is a time inconsistency in between, what we need to do is we need to predict the recovery rate. So we need to discount the recovery rate from the future to today's date, right? So the the challenge in in developing an LGD model is that you are not only using behavioral factors like the PD model, but you are using, so not only the recovery, so you are not only using, the behavioral factors to identify LGD, but also you are bringing in the recovery factors. So you need to understand what are the factors which clearly drives the recovery. So what is the volume of the recovery that can be made, right, from the historical recovery behavior. And once you have an idea about that, there you can try to frame an idea about the, so once you have that idea, you discount that, and what you get is your LGD, right? So LGD model comprises not only behavioral variables but also recovery variables and discounting factors also. Therefore we need to zero down on our discounting factor over there, right? So this is the basic idea behind an LGD. Now, since an LG, talking about an LGD model, there are two types of LGD model, or two types of possibilities while you are predicting the LGD model. So based on the historical data, right? So in a historical data, when you are using a historical data, you will come across two types of recovery processes. So one recovery process is a complete workout process. So it's a complete workout process. So a complete workout comprises of those accounts, whose recovery process has been completed. So what we have over here is a complete workout process. And the second over here is that those accounts which are still under recovery. So that is your incomplete recovery or your incomplete workout process. Incomplete workout. So over here, one thing that we have is we have a complete workout process, and the second that we have is an incomplete workout process, right? So for the accounts which have already been, for whom recovery has already been conducted, you have a clear picture of the recovery, right? And when you do not have an end idea, so then we need to extrapolate the workout procedure. So the economy, it is still under recovery, so we need to extrapolate the process, and we need to find out the discounted recovery, that how would the recovery be looking like, right? So for all the accounts over time, on month, how has the recoveries looked like? So that is where, to assess that, we come across something called a cumulative recovery curve. So over here, you look into the recovery curve to understand what is the time period over which you need to consider the recovery processes for. So over here, what you have is that of recovery curves. So we'll come across all these concepts, right? So the entire idea I'm like introducing these concepts LGD, PD, and LGD is that over here when we talk about personal loan, we should also know that what are the type of variables, or if we have to develop a model for a personal loan portfolio, how are we supposed to go about with that? What are the key variables that we need to look into? What are the key variables that we need to look into for PD model? What are the type of accounts that we look into for developing a PD model? What is the time span of the data that we'll use for developing a PD model? And all these sort of, what is the time frame of the data that we use for developing our LGD models, and so on. So these are the different kind of stuff that we need to talk about, right? So is the idea of the basic idea of LGD and you know your PD clear to us? The PD and the LGD concept, the concept of complete workout, incomplete workout, right? And why is it that we would require a discounting factor? So the choice of the discounting factor is another important component of the LGD model, because LGD is something which contains a component which is an overtime component, where you know that you would be realizing the recoveries after a period of time, right? But you need to value those recoveries in today's date, and hence we have a time inconsistency problem involved in recovery, and hence we come up to the part with the discounting factor. Clear? So this is what the basic this is what the very basic idea of LGD is. Now we'll go back to the personal loan as a product, right? We'll try to assess the sources of risk, and we'll try and check whether those risks they fall under PD or LGD. Okay. Before I move on, I'll take a question from Vishal, which is there. So Vishal says that, can you explain a little more on incomplete workouts? Okay. So incomplete workouts are cases where recovery is still going on, right? So you have a set of accounts, okay, which has defaulted. You are using a historical data. So my objective is to build a LGD model for the year 2019 for my personal loan portfolio, right? So what I'm trying to do over here is I'm trying to understand that. So I have a historical data with me, right? So what is the historical data that I have with me? The historical data contains information on all the accounts which has defaulted, and it contains information on the recoveries that has been committed corresponding to each account. Now in the history, there would be some accounts for whom recovery has been completed, right? So accounts which had defaulted 3-4 years ago, for them the correction has been done. But the accounts which has defaulted 6 months ago, so for them recovery has just initiated, or it's still in process, right? So it is still in process. Now since we have it still in process, therefore the entire recovery workout is not done. Hence it's called incomplete workouts. Right? Clear on this part, Vishal? Great. Okay, correct. So for complete workouts, you already know how much has been recovered, right? So when you are creating a so when we talk about creating snapshots and also, you just discount the recovery. But for incomplete workouts, we need to extrapolate the recovery over a period of time. We need to know that over what approximately over over what period of time will the recovery be completed, or within a given period of time how much of the recovery will be completed. So over here what we have is incomplete workout, right? When we have incomplete workout, this is the next part. So in the case of incomplete workout, we need to extrapolate the recoveries. So we need to extrapolate the recoveries. Extrapolate the recovery. The recovery. So just observe one important thing that you know that for an LGD model, right, the dependent variable that I have is mostly continuous in nature. Mostly continuous in nature. Because what I'm doing is I'm trying to estimate the recovery rates, right, or the recovery. Now, once I see that how much has been recovered out of, what is the present value of the recovery out of the, the total amount of loss that I have had, right? So, or total exposure. So, from there, I can find out that, okay, this is the recovery that has been done. So, 1 minus the recovery rate is my loss given default. So over here, the mostly this is continuous in nature. It was continuous, but mostly fractional in nature. The dependent variable over here is mostly continuous, but fractional in nature. So it lies always between 0 to 1, right? So there would be specified regression modeling techniques for modeling this. So when we come to the statistical discussions, we'll have a discussion on that part. So mostly continuous, but fractional in nature, right? Whereas for the PD model, right, the dependent variable is out and out categorical in nature. So over here, I want to know whether the borrower defaults or not. So this is where this model is categorical in nature. In nature. Right? So that is why the ways of, sorry. Okay, so categorical in nature. So since the PD model has the dependent variable of the PD model is categorical in nature, and that of the LGD model is continuous in nature, therefore the modeling techniques of these two models is also very different, right? Now, before we move into the LGD part, so before we move into these modeling techniques, right? So let's explore personal loans and try to connect this product with loss given default. With how would we deliver the developed loss given, like how would we develop the PD model and how would we develop LGD models for personal loans? Not the process, but to the variables, components, type of observations, data periods, and so on, right? So this is what we do next. So guys, just give me around 10 minutes time, right? I'll just be back in 10 minutes and we'll get started. Okay, just give me 10 minutes time. Okay, so hey, hi guys. So let's get started. So everyone there? Okay, great. So let's get started. So basically, so having introduced the concept of PD and LGD model, so let's just try and explore how it would be for a personal loans portfolio. So what are the basically? Let's try to understand that what exactly are the sources of risk for the personal loans portfolio. So sources of risk, and when I say sources of risk, I am essentially focusing on the sources of the behavior risk, right? The sources of risk. Now, how can you identify a more risky borrower from a less risky borrower of personal sources of riskiness? Okay, sources of the riskiness. Now, when we talk about the sources of riskiness of the loan, so basically what we are trying to do over here is whenever we are developing a PD model or an LGD model, we are trying to uh, rank the borrowers according to their riskiness or try to identify the relative riskiness of borrowers. Relative riskiness. Now, one very important source or one very important variable which can help us assess the relative riskiness of a borrower is riskiness of the borrower. So one variable which can actually help us, do this thing is the delinquency, the pattern of delinquency of the borrowers. So whether a borrower has been active, uh, delinquent, delinquent, or whether the borrower has been inactive. Now, these three sources of riskiness, right, based on their behavior, will help us assess the riskiness of the borrowers who are, who are relatively active and non-delinquent, delinquent and inactive. Now, one thing I can clearly say is that the active borrowers are low risk borrowers. Delinquent borrowers are high risk borrowers, or rather, I should say they are relatively high risk borrowers. And inactive borrowers are kind of indeterminate borrowers, or their riskiness cannot be determined, right? Because they are indeterminate, so they have never used, or they have hardly used their you know they have hardly used their behavior strategies, so they have hardly used their uh, personal loans or something. But it is difficult to have for personal loans at least, it is difficult to have inactive borrowers, right? Because so guys, so if you actually take a loan, you have to start paying the EMIs, right? So you do not have any option of being an active or an inactive borrower. So inactive or active borrower is a segment for credit cards, right? So you have a card but you don't use it. That is not always the case for personal loans. So for personal loans, these two are the more relevant segments, right? So by looking into, so basically, I can always tell you that the probability to default for the low risk borrowers, or I'll call it the PDA, and the probability to default for the delinquent borrowers, PDD, is always more. So this is always higher than this, right? So PDD is always greater than or equal to PDA. So for active and non-delinquent borrowers, the probability of default would is considered to be relatively lesser than that of the delinquent borrowers. So over here, one thing you can see is that this delinquency variable that I'm talking about, this delinquency variable is a behavioral variable. It arises from the behavior of the borrower, right? So based on the behavior that the borrower has, you can say that okay, this borrower is active, delinquent, etc. And if a borrower has a very, they have a very prominent delinquency history in the payment of the loan, then you know that yes, this borrower is relatively more risky than a borrower who has never been delinquent, because if a borrower consistently goes in delinquent and comes back by paying back the EMI, so if he has a rollover into delinquency, right, so 30 days plus or more, and then he pays back 2 months EMIs together and gets back current, and again he pays back, again he gets back current, and it goes on like that, then you know that there is a kind of challenge, right, that this account has, and therefore there can be one instance where he goes into delinquency and keeps on going to delinquency and doesn't turn back current, right? So in that way, this is like delinquent borrowers are considered to be relatively more riskier than the non-delinquent borrowers, right? So this is one source of riskiness that borrowers have. For say if you have two personal loan, if you have two borrowers, you have taken personal loan, and one has been constantly going on delinquent, coming back, going delinquent, coming back, but has been current on your books, right? And there is another borrower who has been diligently paying without going delinquent. Then you know that yes, it is always this good borrower who has, or it is always this borrower kind of who has the capability to to be a lower defaulter, so he's a relatively less risk borrower. So in this way you can, so therefore delinquency variable is an important variable which enters into a probability of default model, right? So this is one very important variable. In fact, dividing the population or creating segments based on delinquency status is also prevalent. So this is also a very important segmentation variable for the model. Right, so there is a very important segmentation variable as well. This is also an important segmentation variable. Now, the relative riskiness of the borrower may also differ based on the ownership of the assets. Say, for example, I have a borrower, right? A borrower A who has a personal loan and a current account with me, who has a personal loan going on with my bank, right? And also has a current account like an overdraft account with me, right? And there is a borrower 2 has only personal loans, right? So now for the bank, the person or the account who has a personal loan along with an overdraft, will be considered as a more risky borrower than the borrower who has only a personal loan. So this in this case, this guy is a high risk borrower. We have a low risk borrower. Now the question that arises is, why is it that if in a model, right, if we have, if there are accounts with current accounts and there are accounts without current account, why is it that accounts with current account are considered to be more riskier, right? Why is it that we would consider them to be more riskier than those guys who do not have any current account? So over here, the logic over here is, say for example, this guy has a personal loan, right? And he has taken a personal loan of 3 lakhs, right? Once he has taken a personal loan of 3 lakhs, the next thing that he talks about over here is that he has already paid back 2 lakhs, right? And there is and he has an overdraft of 2.5 lakhs, right? So this guy also has an overdraft of 2.5 lakhs. Now over here, what we get to see is that, say this guy, after paying 2 lakhs, so he defaults. So when this guy defaults, there is 1 lakh which is outstanding, right? Now what this guy does is he overdraws. So if he's defaulting on the personal loan, it means that his credibility to pay back loan has deteriorated. And what he does is he draws the money from the overdraft, he pays back this 1 lakh amount of loan, and on the OD he defaults. So this guy defaults on the overdraft, right? So therefore, this is where the entire concept comes in. So now on overdraft, so this guy has drawn the money from the overdraft and he has given it to the personal loan. He has settled the PL account, but he goes and defaults in the overdraft. Therefore, with overdraft, the stake is higher for the bank because the rate of interest on overdraft lending is much higher. If he goes delinquent on the overdraft and he defaults on the overdrafts, then the bank earns a higher loss, right? So they face a higher exposure. So that is the reason why this borrower A, is considered to be a relatively high risk borrower than a borrower B, who has only taken a personal loan. So personal loan with overdraft is also a very risky criteria. So basically, the next level of criteria that we can think about, or which helps us assess the relative riskiness of the OD, relative riskiness of the borrower, is the OD segment versus the non-OD segment. OD segment versus the non-OD segment. So this is yet another kind of variable, the OD variables or overdraft variables which might enter into the model. So while developing the probability of default models, I not only consider the loans, which is a variable which is very central to personal loans, but also what I do is I consider the variables from the overdraft side as well. and then what I do is I find out which are the most key variables which will affect the probability of the borrower to default, right? And the reason as to why I can include overdraft or credit card variables is because their existence, so if I have a this kind of thing. So if I have a overdraft kind of a product along with me, and I have a personal loan along with that, then I turn out to be a relatively more risky borrower than that of the personal loans. Than only without personal loans, right? So is this idea clear? So the different kind of variables which enter. So one is delinquency based variables will enter. Second is if the guy has overdraft, so overdraft or current account oriented variables will enter into the model. And finally the model variables. Then we'll finally reach out the most significant variables which are affecting the probability of default. But these are some important variables which should enter into the model, right? Clear up to this point? Great. Now comes the next part. That what do you think should be the type of the loan specific variable which should enter into these models? What type of loan specific uh, variables can enter into develop a PD model? To develop a PD model, the type of loan specific variables that can enter are so loan specific or borrower specific information. Specific variables. So over here in loan specific variables, one very important variable which will enter into the model is the month on books. That is the vintage for which a borrower has been on the books of the bank. So this is the month on books. Or as we call the MOB, right? So the month on books will give us an idea about how long has the borrower been on the books of the bank, and greater the vintage of the borrower on the books of the bank, lower are the chances of the borrower to default. So that the probability of default is very negatively related to the month on books. For developing PD models, PD models for retail products, month on books is actually a very important variable, right? So one is the month on books, right? So basically the next part is the outstanding principal. So what is the proportion of the outstanding principal relative to the total amount of loan that has been taken? So outstanding principal. So then we also have late fee charges and etc. So basically over here what we are looking at is outstanding principal. So higher the outstanding principal at a given point of time is, right, the higher are the chances of the borrower to default, or higher the ratio of outstanding principal to the total loan amount is at a given point of time, the more prone is the borrower to to default. Or similarly, another kind of variable is the EMI by the income. EMI by the principal. So EMI by the income. So in month on books. So okay, before I proceed, I'll take up a question which Karan has. That what exactly is month on books? Month on books is the number of months for which the account has been on the books of the bank. So for example, I have started a personal loan, right, of 5 years. So and I started that only last January. Last January, as it I mean last January, that is January 2017, right? So standing today, so as on 31st May, right, the month on books will be 31st May 2018 minus the 1st of Jan 2017. So I opened the account on 1st of Jan 2017, and uh, what I did over here is that as on 31st May I'm still on the books of the bank. I'm paying back the EMI and so on. So for how many months have I been on the books of the bank? So for I have been on the books of the bank for nearly 17 months. So it is the difference between the account opening date when the account was opened with that particular bank for the particular product, account opening date to account opening date minus the as on date. That is the date on as on which the report is being generated. So that is what the month on books is. So month on books is nothing but it is the number of months for which an account has been on the books of the bank, or it is the vintage of the borrower on the banking books. Right? Clear, Karan? Yes. So how old the loans? Now coming to some of the variables on LGD. So if you look into the variables which we are talking about from the point of view of the probability of default, right? You will see that most of these are the behavioral variables. So variables which explain or which gives us an idea about changes in the riskiness of the borrower's status. Right. So these are all behavioral variables. So the question that comes out over here is that what type of variables do we expect to have for LGD models? So for LGD models, we'll generally have variables which you know cover the recovery side of things, which have which talk about the recovery variables. Recovery variables like collection, collection charges, right? Then recovery, so recovery balances or outstanding recovery to be done, and so on. So mostly, so the variables for LGD will be a mixture of behavioral variables and recovery variables, right? So just some of the important variables would be variables like collection charges. So how much is what are the collection expenditures? How much has been collected, and so on, right? So it will also involve variables like uh, for how many months recovery, for how many months an account has been into the recovery side of things. So for how many months is the account into recovery? What is the proportion of the recovery which has been done as a part of this model, and so on. So these will be some specific, kind of recovery variables. Now, Guys, just give me a moment. Okay. Uh, so coming to Kumar's question first, right? So Kumar is asking, how is EMI by income a behavioral variable? Don't we check the financial capacity of the borrower by this variable? Yes, we check the capacity of the borrower by this variable, but again, this variable can also be used to track the credit degradation of the borrower, right? Say suppose the guy loses his job, right? So then the income becomes zero, or the average income goes down. Then the EMI by the income will increase, right? So, so in that way, by looking into the trend of the EMI by the income, you can actually make out. But yes, it's primarily it's a variable. It's mostly an acquisition variable, right? So, but however, yes, you can use it to check for the sudden credit or the income capacity or the payment capacity of the borrower. Okay. Now, the next part over here is that, so talking about the LGD model variables. So, what are the different types of the LGD model variables which can actually occur? Or how is it that the LGD, how is it we can define the variables in the LGD model? Now, one thing that we need to understand is there would be different variables, right, in an LGD model, which will help us assess whether so there would be different kind of there are different factors because of which LGD arises or the the default arises, right? So there are three broad reasons as to why the default happens. So we do have kind of three broad reasons. So one of the reason is that the account goes under a payment restructure or a payment plan. Three broad reasons. One is a payment plan. So basically, a guy has been put under a particular special payment plan procedure, right? The second that happens over here is the restructured loans. So the loans get restructured, or this part is known as the loan restructure. There is restructured loan or LRD as we call it. Now the next part that happens is that is a simple 90 days past due. 90 days past due. Now, depending on now that the nature of the variables will be very different depending on like uh, it would depend on the nature of the reason of because of which default has happened, right? Now, obviously, one important variable that would enter an LGD model is the exposure at default. The EAD values are going to play a very important role as far as model development of LGD is concerned. So the exposure, the outstanding exposure that is there, because to compute the final LGD, right, you would require the EAD value. Now, the next idea over here is also that you would require some kind of a collateral value over here. So the information on the collateral will also come up. But over here, since it's a personal loan, since a personal loan is an unsecured lending, therefore this collateral will not be a part of it. You don't have any collateral as such. So all you have given is an unsecured loan, and in case of a default, you just need to recover as much as possible for that loan, so that the overall loss value is minimized. Now, along with that, again, the next part is also that the EAD, with this EAD value over here, right? Uh, so we also need to understand the costs which are associated with the collection, right? The events which create the cost, such as holding costs of a collateral if there are any collateral. If you are into recovery position, it's a recovery cost. Then the next thing that also comes into account is how much of the recovery, or uh, like how much of the recovery has been completed or outstanding recoveries over the last 12 months and so on. So these are variables which enter into the model along with along with along with certain behavioral factors such as credit deterioration, because the rate at which the account has deteriorated would impact the LGD or the loss given default that is there. So it would impact the recovery process. So any variables which are which impact the recovery process enter into the model as uh, input variable, right? So these are more or less the overall overview of the variables that enter into a PD or an LGD model for a personal loan portfolio. So what we have looked into today is the key risk segments that are there for personal loans, the key variables that are the key set of variables that are there, the key business problem that a PD model tries to answer, the key PD model, the key problem that a LGD model tries to answer, the key variables which impact PD, and key variables which impact LGD are all in place, right? So this is how it happens. So in the next class, what we talk about is the data requirements for this model, and then we'll talk about PD LGD cases for a mortgage portfolio, right? So that is what we do in the next class. So this much from my end for the day, and let's catch up next week. Thank you. Bye bye. Have a great week ahead. I'll share this editor when I mean share this PDF, the PDF version of this whiteboard work, as well as I'll share the recording to the evening. Thank you. And in case you have any queries, you want to know anything, just write back to me. Next week, same time. Bye bye.